Hey everybody, welcome to Things You Should Know Accounting Edition. Today we will cover our last video focused purely on T accounts. After today, future videos will have T accounts in them, but they'll be addressing more advanced accounting items. Today we're going to look at Jello's expenses. Unfortunately, a business like Jello's Coffee Shop does have costs, and we need to keep up on those costs. The first T account we will cover is recording our expenses due to salaries. Expenses always decrease to owner's equity, and like all decreases, it'll appear on the left side of the T account. If you ever need to reduce expenses, they'll be recorded on the right hand side. These decreases in expenses are very rare. Most often it's caused by corrections you need to make by having earlier misstated expenses or by transfers. Jello's first expense is for his employees. He paid his employees, as you can see, $3,000 in the month of January. Not too bad for salaries. That's actually, honestly, not too bad at all for a coffee shop. Now, the analysis. The asset account this transaction is cash, and we'll decrease it by $3,000. And see, we have it there. So we marked it N to N, $3,000 decrease, credit right side, left side's debit. Remember that it's not up and down for a credit debit, it's left right. The expense account under the owner's equity will be salaries expense. It's a brand new expense account we're going to open up, and it will be increased by $3,000. So we'll have it on the left hand side, we'll debit salaries expense, and then we'll see it's $3,000 O to O. We verify the left-right rules. Remember, the left side of the columns need to equal the right side. So left side of the columns, $3,000 salary expense does offset the $3,000 in cash. Jello's second transaction we'll make a little more complicated. His landlord not only needs to be paid rent, but will also need to be paid utilities. So we'll cover them separately, and we track them separately for recording purposes to see how much rent itself costs versus utilities. Jello paid $2,000 for rent in the month of January, not a bad rent for a coffee shop, and he paid out $1,000 for the electricity. After all, those coffee machines don't run themselves. They need electricity to run. He needs to have a nice place for people to sit. He's going to overtake Starbucks someday. The analysis for this transaction, P and Q will be the asset account, will be tracked cash. We're going to do it in two separate ones so we can just have the rent there for $2,000, matches the Q. $1,000 cash decrease for the utilities, which is just electricity. That's all we're going to worry about. For R, the first expense account will be electricity expense. Once more, a new expense account. Like all other expense accounts, you do an increase, and it'll be on the left-hand side. You'll debit electricity, $1,000, R to R. The second expense account will be rent expense. Once more, it'll be a brand new rent expense under owner's equity. We'll mark it with an S. We'll once again increase it, so we'll debit it. $2,000 rent expense on the left, and once again it's offset by the cash. Finally, we verify the left-right rules. All the left columns, 1,000 plus 2,000 equals 3,000, equals the right side of all transactions, which is 1,000 plus 2,000 equals 3,000. Our final account is something different than what we did before. In companies that are sole proprietorships and partnerships, the owners themselves do not generally pay themselves salaries. There are numerous advantages and disadvantages for this, and perhaps in the future we'll go over that in more depth. In order for Jello to obtain funds to live on, he'll need to create an account to record his withdrawals. Ownership withdrawals are against previously earned profits and become part of the capital, or against profits that are expected in the future. Basically, if the withdrawal is bigger than what they've made in profit. Jello is doing fairly well with his business, but he doesn't want to get used to withdrawing too much money in case the business has a harder time in the future. So he sets up what is called a drawing account. This account is separate from his owner's equity account. He keeps the owner's equity account to record capital investment and capital withdrawal. The preferred method in accounting is to have a separate account for withdrawing for personal use of money. Increases in the drawing account, which decrease the owner's equity, are recorded on the left side of the drawing T account. So basically, it's a separate expense account. They just don't call it salary. It's a personal use for the owner to withdraw on. So Jello decided to pay himself $5,000 for the month of January. It's doing fairly well. He could have paid himself a lot more, but he decided to go conservative. The asset account in this transaction is cash, and it'll be decreased by $5,000 as it goes from the bank account to Jello's pocket. The drawing account, which is under the owner's equity, will be increased by $5,000 to show that as of January, he had $5,000 of personal use of money. We verify the left-right rules. All the left-hand side needs to equal the right-hand side, so $5,000 equals $5,000. So it falls within the left-right rules and is a correct accounting transaction. Final step, guys, is to go back to the general ledger. I will show you where the new accounts are. If you notice, we have three new accounts right here: electricity expense, rent expense, and salary expense. I've also recorded which transaction number, or in this case letter, they are. There's the new draw account and then the new cash, how much we've withdrawn in cash. For a total of $11,000 this month, Jello has had in expenses. Once again, right side equals all the left sides. So 3 plus 1 plus 2 plus 5 equals $11,000 in cash reduced. And we'll reflect it by showing 1 plus 2 plus 3 plus 5,000, which for a total of $11,000 increase in expenses or owner's equity account. Well, guys, that's it for now. Up next, we'll go over trial balance in detail, what it is, how to find errors, and how to correct those errors. Until we talk again, take care.